All right. Chapter 10 is on the current liabilities. So the first exercise here reads, Bob Nebo sold 30,000 annual subscriptions for $105 during December. These new subscribers will receive monthly issues beginning the next January. In addition, the business had taxable income of $970 for the first quarter. The rate is 40%. And the payments will be made in April. Prepare the current liabilities section. Okay, so what's key to know here, it says prepare the current liabilities section on March 31st. So we've got 3 months that have expired. So when we look at the subscriptions here, we've got 30,000 annual subscriptions at $105. 3 of those 12 months have expired, so we got 9 12s. So we have $2,362,500 in our current liabilities. The federal income tax payable, again, it was a $970,000 number at 40%, leaves us with a liability of $388,000. So that takes care of number 1, the current liabilities. Number 2, this enterprise issues a $400,000 90-day 5% note. All right, Bennett issues the note. So first, journalize Bennett's entries. Well, it was inventory. They took it as a notes payable. Number 2, they paid it. So now the notes payable goes away. The 5% is calculated by taking the $400,000 times 5%, and it was a 90 over 360 day, only 90 days. Remember that 5% is an annual number, so we have to do the number of days that were out there, 90 over 360. It's $5,000, so the total cash would be $405. Looking on the opposite side here, there is a notes receivable and sales. Okay, and then now they're getting paid it, so $405,000 is received. The receivable goes away, and interest revenue is recorded. Moving on to number 3, evaluating alternative notes. A borrower has 2 alternatives for a loan. 1, issue $150,000 4% note, or issue $150,000 45 note that the creditor discounts at 4%. So how does that look? Well, calculate the amount of interest expense for each option. $150,000, 4%. It's a 45-day loan, so 45 over 360 is $750. Letter B, it says determine the proceeds received by the borrower. Well, number 1, that's the normal $150,000 note. You get $150,000 up front. The second part, the issue, the $150,000 where they discount, the difference there is it's $150,000, but they take out the interest up front, so you only get $149,250 in proceeds. So which alternative is more favorable to the borrower? Well, I would think alternative 1, because you probably needed all $150,000 to purchase whatever it is that you were doing. So that's what proceeds you're going to get, versus in scenario 2, they take it away. So that's how that works. Quite honestly, you see issue number 1. That's typical. Taking the interest out up front is actually not very common. And quite honestly, taking it out up front will actually result in just an ever so slightly higher interest rate. So it's not 4% as you notice here. Effectively, it's 4.02, just ever so slightly higher. Number 6, fixed asset purchase with a note. On January 30, Collins Management Company purchased land for $400,000 and a building for $560,000, paying $360,000 in cash and issuing a 5% note on the balance. The terms of the note provide for 20 semi-annual payments of $30,000 on the principal plus interest accrued. Journalize the entry. So letter A, the transaction on January. So they bought the building, land, they paid some cash, $600,000 was the balance to the note. Letter B, it says the payment for the first installment. Well, the first installment, and they said $30,000 is what has to get paid. There's semi-annual payments of $30,000 plus interest accrued. Well, there was $600,000 out there, right there, at 5%, 6 months, 6/12 is a $15,000 interest. So our cash payment is $45,000. Then on June 30th, letter C, another payment. Again, we take down the note by 30. Now we actually have not $600,000 out there, but only $570 times 5% times a half a year. That's $14,000. So our payments, our cash payments will actually go down, but we're making the payments against the note consistent. Number 7, we got PepsiCo here reported the following information about its long-term debt in the notes. How much of the long-term debt was disclosed as a current liability on the current year's December 31st balance sheet? Well, if you notice, the entire total long-term debt is $27.917. However, the current portion is the 44096. We would put that in the current of all the debt. So if you got a mortgage, you got a 30-year mortgage, 29 years would be considered long-term. This next year, 1 year, would be the current portion. How much did the total current liabilities change between the preceding year and the current year? Well, we're just looking at the difference between the 4096 and the 2224, so it's a difference of 1872. If PepsiCo did not issue any additional long-term debt next year, what would be the total long-term debt on December 31st of the upcoming year? Okay, so no new, well, the total was 27.9, and it says here, in the next year, we would have already paid the $4 million, or 4096. What would be the total? Well, it would be just the 23,821. Number 8, calculating payroll. An employee earns 30 hours per hour, earns $30 per hour, and 1.5 times that rate for all hours in excess of 40. The employee worked 54 hours during the week. Calculate gross and net. Social Security tax 6%, Medicare tax 1.5%, and employee's federal income tax to be withheld is $295. So the first 40 hours at 30, that was 54 hours. So the next 14 hours at 30, and take that times 1.5. So our gross is 1830. Deductions, 6% times 1830, 1.5% for Medicare tax times 1830. They told us it was $295 withholding. Our net pay then is $1397. Moving to number 11, payroll tax entries. According to a summary of the payroll of Mountain Streaming, $110,000 was subject to 6% Social Security, 1.5% at Medicare. Also, $25,000 was subject to state and federal unemployment taxes. Letter A, calculate the employer payroll taxes using the following rates. State unemployment 5.4% and federal unemployment at 0.8%. So you take all $110,000 at 6%. You take $110,000 at 1.5% for Medicare, and then in the reading it says only $25,000 is subject to the state unemployment rate of 5.4%, and again 25% only at 0.8% for the federal. So our total taxes then is $9,800, and that's our total expense. We have a payable to Social Security tax payable, Medicare tax payable, state unemployment tax payable, and federal unemployment tax payable. So those are all employer expenses or costs. Employee, it would be only Social Security and only Medicare. So the total of Social Security tax payable for both the employee and the employer would be the 6,600 times 2. Each pays half. Same with Medicare, 1,650 times 2. Each pays half. But the state unemployment and the federal unemployment, that is only an employer tax. Number 16 is our next one, and it reads, a business provides its employees with varying amounts of vacation per the year, depending on the length of employment. The estimated amount of the current year's vacation pay is $42,000. Well, journalize the adjusting entry required at January 31, the end of the first month of the current year, to record the accrued. So what we're going to do is take all $42,000, take it times 1/12, and book it to a payable. So we'll record the expense, and we'll record the payable. How is the vacation pay reported on the company's balance sheet? Well, most likely, it's going to be considered a current liability, right? And when is the amount removed from the company's balance sheet? If the employees are allowed to accumulate the vacation pay, then the estimated vacation pay will not be taken in the current year. It will be reported as a long-term liability. However, when employees take vacations, the answer to the question, the liability for vacation pay is decreased. Number 17. Uri operates a chain of gift shops. The company maintains a defined contribution pension plan for its employees. The plan requires quarterly installments to be paid to the funding agent by the 15th of the month following the end of the quarter. Assume that the pension cost is $365,000 for the quarter December 31st. All right. Journalize the entries to record the accrued pension liability and the payment. Well, we want to get that on December 31st, so pension expense and then an unfunded pension liability. So current, it's noted there, it's a liability. 15 days after the quarter, January 15, now we pay it and that liability is removed. How does a defined contribution plan differ from a defined benefit? Well, a defined contribution plan, and as it reads here, the company invests contributions on behalf of the employee during the employee's working years. So that is like a 401k or a 403b. It's defined. The defined benefit is different in that the employer is obligated to fund the employee's future pension benefits. So in a defined benefit plan, the company pays the employee a fixed annual amount based on a formula. So it's completely different. There is a number that we need to attain and fund. The defined contribution is just what is our required contribution, typically 1%. The defined benefit is this is what we are guaranteeing that benefit will be. Okay, we'll stop there for a moment and then we'll resume again with the last few questions and problem from Chapter 10.